with a $30 trillion national debt, we can't withstand that. It would be impossible. It's
Right.
pure math. I mean, 5% interest rate on 30 trillion is 1.5 trillion of interest payments. When the federal government takes in around 4 trillion in federal tax receipts, so that would be a massive component of our tax revenue going just towards servicing interest on the debt. And ultimately, where this is all headed, the question is, how long can they stave this off with QE programs and the Fed stepping in as the buyer of last resorts, trying to suppress?
Welcome to Gold Silver Pros, where you'll learn the ins and outs of the gold and silver markets. Searching for the best precious metals deal? Our affiliates are of the utmost trust, quality, and highest customer service in the industry. Shop with our trusted partner, 𝙎𝙊𝙇𝙑𝙀. Access special deals on silver, gold, and platinum through our website or call 307-264-9441.
Hey everybody, it's Rob Keynes with goldsilverpros.com. We're recording this on Friday, June 24th, 2022. It'll be out in a couple of days for you guys. I have a returning friend and guest to the program. It is Steve Penny. The Silver Chartist is back. Steve, how are you doing?
Doing great, Rob. Great to connect with you. Out of the home office. My internet's out of my house, so I'm over. So hopefully everything works okay here. But I'm looking forward to a good conversation.
Yeah, I think it will be. And your kids will be bugging your mother-in-law to death while we do this interview. So we won't take too long. We'll give her a little bit of a break in a few minutes. So, I always wonder which is worse. Is it the internet going down or is it the heat? Because if I don't have the internet, I don't have the business and I don't have access to information. I'm an information junkie. That's bad. But if I don't have electricity, then, we could die in Texas because it's 104 outside this week. So I don't know. It's kind of, which one is worse for you?
I hear you. It's tough being out without access to that information. I know you and I are information junkies, and it's hard without that internet.
All right, so let's get into the business at hand. So we're going to talk about a couple of things today. We're going to continue our conversation on silver inventories and what Steve sees in the silver market. And I promise you guys, since that's the hot topic right now, we will get to it. However, Steve is noticing something with regards to the bond market and existing yields and resistance lines. And I think he's going to talk about it from the perspective of how fast can this run before there needs to be a pullback or a cooling off period. Steve, what are you seeing in the bond markets?
Yeah, so I'm going to speak in multiple timeframes here. From a big picture perspective, I think March of 2020 marked the end of a 40-year bull market in bonds. In other words, 4 decades of declining interest rates. And this is significant because most money managers, investment folks have never lived through an era of rising interest rates. And we've seen the nominal yield on the 10-year go from a low of 0.36 up to over 3% in a relatively short period of time. So that's brought us to where we are now. And from a technical perspective, the yield on the 10-year is the most overbought it's been since 1981. And it's right up against trendline resistance going back 4 decades. So what I'm getting at here is, yes, I think the trend has changed in bonds, in yields, but we're due for a pullback here in nominal yields. And I think all of the Fed rate hike talk and tightening rhetoric is more than fully priced in now. And I think that bodes well for the metals because, it's fully priced in. The worst is priced in from my perspective. And any kind of relenting on this aggressive tightening policy is going to be a tailwind for the metals, and it's going to send real rates back in the negative direction, which is rocket fuel for silver and gold.
Yep, I kind of agree with you. I think the stresses on the economy have forced people, the bondholders and the bond buyers, I say, are some of the smartest from the perspective of they study more data. When I was writing for Seeking Alpha, the bond guys, to me, were some of the smartest guys who would call stuff ahead of time. Because if you look at bonds and the way that works, when you're pricing a bond, you have to price in macroeconomic risks, not necessarily with stocks. I think stocks, a lot of time, people ignore macroeconomic risks and ignore the macro and ignore fundamentals, and you just get on this growth thing. But bond investors are different. Yeah. And so I think because the rates have been going up, that was a sign that people feared what was coming down the road. Of course, you had Russia, Ukraine, which is the big one, but that brought to attention resources for the first time, Stephen, forever, that we're now talking about resources. They're not unlimited. I think people realize you don't have unlimited money to send to Ukraine. You don't have unlimited money to, for Biden to buy gas cards, and we don't have the chips to make them anyway. And the Austrian government came out, I think it was yesterday or the day before, and said that they're going to give 500 euros, to each person to combat inflation. And I'm thinking, okay, so you're creating more inflation to combat the effects of the previous inflation that you had because you couldn't say no.
Yep.
And we have limited resources, and the bond market's reflecting the pressure on limited resources. An amount of money has been printed to buy up all these commodities and all these things that now we don't have enough of, it's led to supply chain problems. So I do think that it's accurately looking at macroeconomic risk. But I also agree with you that markets don't go in straight lines. Even though we have like a bull thesis for gold and silver, they don't go in a straight line. They go up, they go down, they go up, they go down, and you have to look at the trends. Same thing happens with the bond market in any market. Just because rates have risen and we think that they should continue to rise doesn't mean they're going to do absolutely. They're going to be pullbacks and things. So follow-up question based on everything I just said. Do you think, Steve, the long-term direction for bond rates is higher or lower? And how deep of a move is this? How long could this be that we see rising bond rates?
Well, if you revert to the mean, you're looking at 5, 6, 7% on the 10-year. The problem is with a $30 trillion national debt, we can't withstand that. It would be impossible. It's
right.
Pure math. 5% interest rate on 30 trillion is 1.5 trillion of interest payments when the federal government takes in around 4 trillion in federal tax receipts. So that would be a massive component of our tax revenue going just towards servicing interest on the debt. And ultimately, where this is all headed, the question is, how long can they stave this off with QE programs and the Fed stepping in as the buyer of last resorts, trying to suppress interest rates? So that remains to be seen. I think when the Fed pivots, that's going to be a big catalyst for gold. But I think it's going to be the massive catalyst, and it's coming one of these times, is when they try that and it doesn't work. One of these days they're going to step in and say, hey, we're doing QE and all these programs, and they get the opposite effect of what they desire. I'm not saying that's going to happen this time, but that's eventually going to happen, I think.
I think that's the crack up boom, and that's really the death of the dollar that the Austrian economist, that study and that dogma talks about. Is we've seen this story in the past, and the Fed is just doing the same thing that's been done in the past. It's a different flavor of ice cream because we have a world full of fiat currencies for the first time in history. So it's not the same vanilla. It could be, vanilla with almonds or chocolate even, but the end effects are going to be the same. I think it's just going to be more spectacular. It's going to be more fiat currencies, busting out than just, the ones that we've had in the past were more isolated events. And I think it's going to be more destructive. And it's interesting, you note that it's a reversal of the 40-year bull market in bonds. Last year, I did a video where I looked at a 700-year chart of bonds. So this is sovereign bonds across all countries, all time periods over 700 years. We have had, Steve, a falling of bond rates for 700 years, dating back to like the medieval ages.
Oh my
so in
God.
other words, we've been in an environment in which we've had more and more government largesse dating back 7 centuries across the world. It hasn't just been since 1913 in the United States. This has been what I call a super trend. So if we in fact have a reversal of the super trend of that 700 years, not just the 40-year, but the 700-year, wouldn't that also be a really strong argument for the strength of gold and silver now? Because we're essentially saying the system we've used for the last 700 years is finally busting apart. We've reached the end. We've stretched this rubber band as far as it can possibly go across time, and it's got to snap back. And if that's true, if that 700-year snapback happens, boy, we're looking at really high interest rates, potentially severe economic problems, and people going back to the metals, I think, as safe havens, but also as money. What are your thoughts?
Yeah, I think it's inevitable. That's fascinating. I'll have to go back and watch that video because I had no idea that it would go back that far. But yeah, reality matters. And, eventually silver and gold do a full accounting for the expansion of debt-based fiat currency, to quote Mike Maloney. That's going to happen. It always has for thousands of years. This time will be no different. And like you said, we're approaching a critical juncture where, they're going to have to either sacrifice the dollar or crush the economy. That they're going to have to make that choice. And history suggests 100% of the time they choose to sacrifice the dollar and let inflation run hot, and eventually results in the demise of fiat currency. So that's coming. And I think it's coming pretty soon, faster than many people think.
Yeah. The other topic I wanted to chat with you about before we jump off here, because I know you've got a big thing that you're hosting today. I want to talk about available silver inventories. I've been talking with dealers and looking at the COMEX data, which is something that I do. And silver's being pulled off of COMEX. It's been happening for a while, basically dating back to Silver Squeeze. And it's being pulled out of London too. But now the trend is starting to happen to gold. It appears as though people are starting to take the gold and silver fully off the COMEX, not even moving it off of the registered trading market, but taking it completely out of the depositories. And to me, I've been calling this for 2 years. There's going to come a point when all available above ground stocks of the precious metals are going to be bid. And I think that's what's happening. And it's happening first in the industrial market. And I think eventually it's going to reach retail. What are your thoughts on, if that's true, if everything that I just supposed to you is true, how does that affect the metals going forward? If the big hands get into the metals market, what does that do for metals prices?
Well, first of all, I defer to experts like you. You're someone who tracks this much closer than me. And I appreciate all the research you do. But I've always known from the beginning that when we look at the price of silver, what we're looking at is a price set based on the supply and demand of paper contracts that can be issued at will by banks such as JP Morgan. And it doesn't represent supply and demand of physical metal. You and I, as retail investors, and all of us could go out and buy all the silver we want and then look at the price of silver on our screen. It's not going to affect it because we're not playing on the COMEX. So I look at that as an upside kicker. Eventually, the COMEX, I think, is going to fail, and we'll see true price discovery. And when that happens, I think we all know the price of silver is going to be much higher. And, the one thought, too, is, the silver squeeze movement is awesome. But what I think is really going to have an effect is when you pit, rather than us retail investors against the bankers, what about the likes of Tesla and Samsung and Apple? When they need physical supply, and then they're against the banks, they need to take physical delivery. And I think, the evidence you're pointing out suggests that could be closer than many people think as well.
It'd be interesting to see how the banks react to that, because the banks have traditionally been the shorts. If you look at the COT reports, commitment of traders from the CFTC, now they don't tell you exactly who all their clients are. So the banks do represent clients, but the banks have their house accounts and they're short there. So the banks have been short. The largest 4 and 8 short traders in gold and silver have been the banks, dating back as far as I can see in the data. It would be interesting to see if a Samsung, an Apple, a Tesla says we need silver, and they go to the banks because the banks trade the market as clients. What does that do to the bank's positions? Now, on one hand, you could say the banks front run everything, so people do come to them, they can get out of that. On the other hand, it could put pressure on the banks to relinquish some of their short trade if a big hand comes in, and that would force the metals prices higher. And to that point, I think the bullion banks are less short in silver than they've pretty much ever been as of late. So the banks are moving along slowly in the silver market and derivative market. Maybe that's already happening. We just don't know about it because those are all private contracts. But it certainly looks as though the banks are changing their position, at least in silver on the COMEX right now. Maybe it has to do with what you just said. I'm not sure.
Yeah, 100%. The COT report for silver looks, the most bullish it's been in years. And, it's interesting. The bankers, they short the paper price, but they're buying physical hand over fist. And you got to ask yourself, why are they doing that? If you look at JP Morgan's physical inventories, they've just been going up at a 45-degree angle for several years now.
So you're a chartist. You look at these markets from a technical perspective. Why we love to have you on the show. Great detail you put into your reports. Fully recommend them for anybody. What do you see going on technically for the precious metals? Are silver and gold in the same place? Are they in different places? Can you summarize that for us?
Yeah, they're in different places. Gold looks, the uptrend is intact. Back on March 8th, when we reached like $2,078, I was saying, from a technical perspective, we're due for a pullback here, but as long as we make a higher low above 1780, that's an uptrend. Well, where was the most recent low? 1785. So that's a higher low. We're hovering right near that 200-day moving average. So we're, by all technical definitions, we're in an uptrend in gold. Gold looks really strong here. Now, silver's just been beaten to a pulp. Who would have thought we'd be at $21 silver in summer of 2022 after all this money printing? I didn't. But from a technical perspective, the first thing I ask myself is, what's the trend? And there really isn't one. We're just in this sideways grind between 20 and 30 for the last 2 years. So you can look at horizontal support and resistance. The most recent low is $20.42. And you can make some if-then statements. If that support gives way, well, then the next support and path of least resistance might be a quick dip down towards 19 or even 18. I think that's a lower probability outcome, but it's possible. But then you've got, some key resistance levels along the way. But the big one being $30. I think once we get above 30, I think $50 comes pretty quick. But let's get above, let's reverse trend first before we start talking about $30 silver. But I think that's eventually coming.
Yeah. In gold, it hit all-time highs around, was it 2062 or 2072? I forget. Last year, I believe. Are we headed back to that point with gold? Do you see on the technical charts that we have a bullish trade here for gold, or is it still sideways?
Yeah, I like to go big to small. So big picture, there's a big cup and handle. It's over 10 years long. And so we carved out this beautiful cup and now this perfect handle. And that would project a measured move. Once you break above the previous high of $2,089, a conservative upside target would be $2,500 in the short term. You just take the cup, or excuse me, the handle portion and flip it. It's about $400 added to $2,089 gives you $2,500. And some people may say, that sounds like a bunch of technical gobbledygook. This matters because institutions and high net worth investors look at this stuff. So it does.
They absolutely do. And there's a whole book of information on this, including investopedia.com, which talks about that exact formation you talked about.
Yeah.
It's an established and well-respected formation, not only in the metals, but in every market. Yeah.
And I think a more accurate way to get a measured move target would be to take the cup portion and flip it. And that's $1,000, and that projects $3,000 gold. So you eventually, as gold is beginning to outperform general equities, these are things institutions look at and they say, that's what makes them say, hey, I want some exposure to gold. And then they look to technicals and they say, well, what are some upside targets? And those are the kind of things that institutions are looking at right now. And, that what unlocks that is a break to new all-time highs above $2,089.
Awesome, Steve. Thanks so much for joining the program. I know you got to get out of here to host an event. We appreciate you popping on with us for a few minutes on a Friday. If people are interested in your service, which I think is excellent, and I get that newsletter that you send out, how do they go about signing up for that?
Yeah, so we're happy to kind of work with you and have an affiliate link with you guys, or you have an affiliate link with us, silverchartistpros.com, and you get a slightly discounted link there. We keep it really affordable anyway, and proud to have Jeff Clark, David Brady on the team as well. And what you get is a fully transparent, over-the-shoulder look at exactly what I'm doing. I don't get everything perfectly correct, but fully transparent, and you see exactly what I'm doing. And hopefully that helps people make better decisions in their own investing.
Yeah, and it's important that you mention those other guys, so you're not just running this by yourself. There's a lot of information in here from three very well-respected people, and that's why you guys have a great service. And again, I'll say this again, every time I mention your name to people in the industry, I'm talking about analysts, miners, executives, things like that, everybody thinks so highly of you and thinks that you need to raise your prices. So when they keep advocating for you to raise your prices, even though I know you're trying to make it inclusive of everybody respective of their budget, the point is the information that you give is so highly thought of by industry experts that you could charge a lot more. So people are signing up for you, are really getting a deal here, and they should take a look at it, even on a trial basis. Just take a look at the information you have. I don't think people are going to get better information anywhere else.
Well, I really appreciate that, Rob. Thank you.
Yeah. Thanks for being on the program, Steve. We'll have you back on. Thanks, everybody, for joining Gold Silver Pros today. Hope you guys have a blessed weekend, and we'll see you next week.